When the market starts climbing higher with each move, traders call it an uptrend. It's a sign of growing confidence, strong demand, and often the start of big opportunities. But how do you spot it? And more importantly, ride it the right way? Understanding uptrends in trading. An uptrend is defined by a series of higher highs and higher lows, forming a distinct upward pattern. This movement signals a market where buyers dominate, continuously driving prices higher. Key characteristics of an uptrend. Impulse moves. Strong upward movement. Sharp price surges marked by strong bullish candlesticks. Each impulse move sets a new higher high, confirming bullish momentum. Corrective moves. Temporary downward retrace. Weaker price movements against the main trend. Consist of small or dull candlesticks forming minor price drops. Often occur due to profit taking from earlier long positions. Confirming an uptrend. A true uptrend requires at least 2 impulse moves and 2 corrective moves, showing a consistent pattern of higher highs and higher lows. Identifying uptrends with trend lines. 1. Marking higher lows. Identify and plot the swing lows, higher lows, on the chart. 2. Drawing the trend line. Connect all the higher lows to form an upward sloping support line. This trend line serves as a reference for potential long entries when the price retests it. 3. Drawing the trend channel. Identify and connect higher highs with a parallel resistance line. This upper boundary acts as a resistance zone where traders may look for temporary sell opportunities during corrective moves. How to trade an uptrend, no indicators needed. Wait for a pullback to a higher low. Don't chase price when it's rising fast. Instead, wait for a weak corrective move that pulls back to a support level, previous resistance turns support, or trend line. Look for rejection at the support. When price approaches the trend line or a previous higher low, observe the candlesticks. Signs of rejection include wicks to the downside, bullish engulfing patterns, or consecutive small-bodied candles. Enter a long trade. Once price shows rejection at support, enter a buy trade. Your stop loss should be placed slightly below the previous higher low. Target the next higher high. Set a take profit at the next expected higher high, previous resistance level. If the trend is strong, you can trail your stop loss below each new higher low to maximize profits. Exit when the trend weakens. An uptrend is weakening if price fails to make a new higher high or breaks below a higher low. If this happens, consider closing the trade or tightening your stop loss. Key insights for trading uptrends. Impulse moves are strong and define the trend direction. Corrective moves are weaker and often result from profit taking. Trading in the direction of the impulse move increases profit potential. An uptrend reverses when the market fails to form new higher lows and starts breaking support, signaling a transition to sideways or downward movement. By mastering these concepts, traders can confidently identify, enter, and manage trades in an uptrend without relying on indicators. Remember, uptrends don't last forever, but knowing how to recognize and act on them can be the edge you need. Stay patient, follow the trend, and let the market show you the way. Trade smart.